Happy Market Monday, everybody. Chris from Fluent Mortgage, Market Fluently. So I thought I would share my comments and the press conference just this last week from Fed Chair Powell. Even though it's quite long, we're going to have some bookmarks in here on key points. I believe my responses, so that way you can kind of jump section to section to section if you wish to do so. Always love listening to the Fed chair speak. He'll allude to it, but bottom line, he told us the exact plan for last year. So all the people in the industry are like, oh my gosh, we didn't know, so eventful, who could have planned? I felt like, if you've been following us, we knew the exact marching orders, exactly what's going to happen in market for the last year. So pretty exciting every time he talks. Let's see what he has to say.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point.
Okay, so making sure you caught that. Was it going to jump 0.75 or 1%? We jumped 0.75% today. As expected, so no surprises in market, or there shouldn't be any corrections based on this alone.
And anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month...
Sorry, we know we don't typically talk core, even though it's a good metric, of course. It skews the numbers some. So we know, at least per their numbers, inflation's closer to 10%.
The consumer price index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run.
So I'm going to stop right there. He gets into more details a little later, but at this point, I don't know if you've caught, he's reiterated and just emphasized right now, 2% inflation no matter what is the goal. And he said, we're going to slow the economy. Translation, he's going to slow the economy, of course, right? We have to, in the way he can in demand. He can't affect supply. That's Congress and the president's job. And he's also realistically going to affect jobs somewhat. So we're going to see employment come up a little bit. We're going to see the economy slow. That's the kind of the goals in order to get 2% inflation. So no matter what else happens, 2% inflation, you hear him say this over and over and over, no matter what, that's what he's aiming for. That's the target. So all the rest of the noise, no matter what else you hear, inflation 2% is the target. And more large jumps, just like we saw, are not off the table and are potentially in line for our next live meeting. So we'll get more data. Let's keep going.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, before we get into that though, one thing, because I do like and respect this man, understand, and he said it earlier on, the reason this is so important, no matter what noise, no matter what fake news, no matter what chatter, inflation steals money from the poorest of poor. They're the most hit, the low class and the lower middle class, right? When we see our dollars worth less, we go from barely getting by to negative. And in terms of savings today, the US is at negative 1%.
our bills are greater than our savings. So literally on an average American, and we know the wealthy are saving tremendous amounts, the average American is spending more than they're taking in on a daily basis. So he's saying, we can't continue this. We have to stop this inflation to protect the most needy of Americans, right? That's why it's so essential.
We did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate.
Did you catch that? Going forward. So in September, we might see a 1% jump.
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. I think the committee broadly feels that we need to get policy at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting.
Mm-hmm.
So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's even.
Okay, there it is. So what was cool about the last year is we knew exactly what the Federal Reserve was going to do every single step along the way, month by month by month. They told us in advance, right? He very articulately said, we're not doing that again. Here's my target, but I'm not going to tell you every step. So each step, we know where we're going to get to, but I'm not taking off the table big raises or little raises, but either way, we're going to be raising it on the path. And he said we're around 2.25 to 2.5 today, right? 2 to 2.25. We're going to jump by end of the year. The target is up 1 to 1.5% more by year's end. And then he also said in the first quarter of 2023, we expect another 0.5% jump. So we could be up, like we've been saying for a while now, another 2% per Fed Reserve Chair, who's told us exactly where we're coming to today. So we are already saying, hey, we're going to be at 5%, 6%, right? And he's like, you're crazy. Well, he told us that. So history repeats itself. He's already told us where we're going by year's end. How quickly in the jumps, we don't know this time, but we know where we're going. In order to get back down to 2%, we have to be more aggressive to get the average overall down there. Hey, at least we know where we're going, right? We can inform our clients. Yay, there's always opportunity. We know. In terms of rates, we go today.
Even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks.
September's huge.
So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral. I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And to try to predict what the appropriate monetary policy response would be. I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. We think it's necessary to have growth slow down. And growth is going to be slowing down this year for a couple of reasons, one of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions. And those are things that we expect, and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2% ultimately.
So there again, he reiterated 2%, 2%, 2%, 2%, 2%. We know the economy is going to slow and we know jobs are going to be affected by it. But truly, based on his mandate of what he has to do, because supply is so high, I'm not going to get into the politics on that side at all. All he can control is demand. And because the supply side isn't changing or getting worse, he has to be aggressive to try and protect the workers.
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further.
Hey, so just so you know, the reason why he's saying that his window of narrowing in terms of avoiding a recession, because remember, we were planning a soft landing. We had a recovery in 2020. We actually had recession in 2020 already in this administrative period. We're talking about another one tomorrow. We'll find out if GDP is reduced. So by definition, literally definitionally, 2 quarters reduced in a row equals recession, right? Not politics. Just in the 5.5 hours of congressional hearings, the feds and all of Congress, I listened to it. Again, not saying if I believe that position to be right or wrong, but what our congressional members have told us. Hey, the last 2 years have been great. Our policies we're going to continue through the next 2 years, maybe even double down and be more aggressive about it. So again, whether you like what's happened from a bill making, money infusion type policies, again, good or bad, I'm not saying. We're going to see more of that per Congress. They're going to do everything they can to continue the course the next 2 years more so than they have the prior 2. So for him, remember, that is the supply side. So he's saying it's getting harder for me on the demand side because we expect supply to continue because we expect a ton more money to be printed. So the hard thing for him, right, to counter inflation, he will have to keep raising rates. So that's why the hard thing for him is he's telling us is, I have a path, but kind of like how we had to pivot hard when we saw that one. Remember the very next day, he's like, man, you just printed 1.4 trillion more, right? He's like, I have to make another pivot. So that's why he's talking about narrowing opportunity for a soft landing, not politics. But if we continue to do what we're doing in terms of supply, it's not going to happen. He will have to kind of shut down the economy in order to hit that 2% mark.
But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen.
Hold on. So as a person on the street, that has happened, literally, out of at least a third of the loans that I'm involved in, a third of the transactions literally verbatim have said that in light of inflation, in light of what's going on, in light of the economy, I'm changing what I'm doing going forward. I'm changing my life. We're seeing it on the street today. So humbly, Mr. Fed Chair, at the national biggest level, at least in Oregon, at least on the street for me, those conversations are being had every day, at least for a third of us Americans, which makes sense, right? We know about a quarter of people are trying to decide today, rent or mortgage or food, mortgage or my meds to stay alive. So this is a really real discussion for people. It is starting to become entrenched. I'm so glad, honestly, no matter what you think about Fed Chair, he has to get inflation down.
Right now, there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course.
Great question.
How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference it really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
Okay, let's stop on that real quick. So that's kind of important. And we've talked about those two concepts. So PCE versus CPI used to always be they cared about our inflation, right? Those of us on the street. And 20 years ago, they're like, we don't really actually care about you as the American people as much. We care about corporations. So we're gonna talk about their inflation, and that's what we're gonna judge. We care about them, PCE. Again, it's not this administration specifically, it's not Powell, about 20 years ago. So they just reiterated, we care mostly about corporations. In general, they're very close to each other in terms of inflation, but unfortunately, our inflation is much higher than theirs, and so there's this gap in terms of some profitability, but different time. Just know the difference. The easy one is P, producer, C, consumer. We're the C one, right? We're the CPI. We're gasoline, food, etc.
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was...
So for those of you who aren't familiar with balance sheet offloading by the Federal Reserve, as you may or may not be aware, for the last several years, they've in essence printed a ton of money to artificially buy down interest rates. Good thing, right? That real estate is one of the major drivers of the U.S. economy, okay? So to keep that hot, they've artificially bought down supply and demand. They've bought down interest rates. Lots of supply, right? What they're tasked or required to do at this point is the opposite. They have to start selling off trillions of dollars of money they printed. So that's going to have the opposite effect of what it's had already a little bit, is where we saw rates jump higher than what the Fed rate jumped, and we're like, why did it spike so high? Because of balance sheet selling. So that it gets absorbed. And he said, hey, I think the market will absorb that well. We haven't even seen them in the ramping it up. As of September, will be full momentum, chunk. So just understand, in addition to raising short-term money, Fed raising the prime rate, we also have that secondary factor influencing mortgage rates because they're traded on the bond market, right? They're securitized. So supply and demand, the Fed's going to be selling back trillions of dollars of bonds. So there's that. This is what they're discussing right now.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So,
well, we saw a similar one in January this year. Remember when the Fed actually gave their guidance and their plan for the next 6 months in December. Most people in our industries were in Mexico and on vacation. No one even really heard what he said. We even talked about it. And then finally it was republished in January after the normal bump. And everybody's like, what the heck did he say last month? I was asleep, right? And then rates exploded. So we saw a little mini tantrum middle of January. But anyway.
The real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And, our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was pretty very
interesting. I mean, I've heard it said from other levels, but the expectation in the beginning of 2020 was that everybody just get vaccinated and we go back to work. That was the ultimate game plan. Okay, at least it's being said.
What a recession really is. It's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't.
Hey, so here's the one thing that I do agree with him on, and we've talked about for a long time. The numbers don't make sense. And this is something we saw in the 80s. Looking back 40 years ago, we're like, remember this in politics, right? Republican in the 80s, happens to be Democrat now. I'm not talking Democrat, Republican, but politicians sometimes don't tell the truth, right? Sometimes people mislead people for gain. So that's one of the things, as a person who follows the reports, so much data manipulation, like he's saying, it just doesn't make sense sometimes. And in his defense, one of the reasons the Federal Reserve waited so long is they were asked to wait because of their mandate, also with jobs. And all of a sudden a report got tossed. They basically turned an F- into an A+ the next month. And then he reacted in his defense. So I do agree with him. It's strange. The numbers, when you put them together, do not match up. They don't add up. It does not make sense. So even though you see me getting mad sometimes or challenging what I think he's saying, he handles himself so well, and I would not want his position whatsoever. He's very smart. It'd be a tough position to be in as the scapegoat for a recession when it comes. It's been reiterated over and over in every congressional meetings. You are a scapegoat, so we better deal with this.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, I hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists, pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to?
What a quote. The same people that are telling us that 1 + 1, well, he didn't say that. The same people that are telling us that we're not in a recession, even though definitionally we are the same people that told us, don't worry, inflation's only transitory, temporary. Of course we don't believe them. Great quote.
Reassure them now that you feel confident in your forecast going forward, and the Fed is ready to respond to a potential downturn in the economy.
I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever.
Whoa, that's not even close to true. So even though I really like and respect this man, humbly, that is not the case. He just said that our savings accounts are getting stronger. Like that contradicts everything he's said thus far, right? The whole reason we have to do this is because of inflation, because they're literally stealing money on unpassed tax. Inflation, just printing money exorbitantly. Hyperinflation is just stealing money from the poor without voting, right? So if you're stealing money from the poor and it's getting tighter every month, we know we're -1% in savings as Americans on average. And that's even taking the fact the rich people are getting super exorbitantly wealthy, right? That's just not true. They're not saving more money. They're spending more money. They're working 2 jobs, 3 jobs. They're deciding between house or food, house or staying alive with medications. It's not true. That's disappointing.
That's not to say that people at the lower end of the income spectrum are suffering, because they are. They're suffering from high inflation. They're going to the to the grocery store
Yes.
and finding that in many cases their paycheck doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning.
So, you notice, he just reiterated what I just said. He spoke true. So unfortunately, understand his role in his position and what he has to say and do sometimes, but he spoke in truth throughout the whole thing. That one statement was somewhat misleading. I humbly believe it to be disingenuous. Maybe he misspoke. But right there, he reiterated what I just said a second ago. All right, guys. That was the entire thing. If he were in front of me, Fed Chairman Powell, truly thank you for what you're doing. I 100% support trying to get inflation back down to 2% to protect those most in need financially. I appreciate usually your candor and also how calm you are. I've listened to many hearings with you where just some of the most foolish, absurd, crazy questions, and you're just calm and collected. So at least from what I've seen thus far, I feel like we're very lucky to have you in that role and position. So again, I support that 2%. Hey everybody, thanks for joining us. Chris Bettis, Fluent Mortgage, market fluently, and that was the Federal Reserve. Again, we know what's going to happen the next 6 months to 9 months. Not every mark, but we know what the goal is in terms of target rates. Talk to you very soon. Bye-bye.